Will China step up its game, and how should U.S. investors position themselves to profit? My next guest, Derrick Scissors. He's a senior fellow in Asian studies at the Heritage Foundation. He joins us now. Derrick, good to have you with us on Bloomberg. What's your estimate for Chinese economic growth? The IMF saying, what, 9.5%? Earlier today, Jim Chanos speaking at the Clinton Global Initiative. Jim Chanos, the head of Kiniko's Capital, he said growth in China more like zero.
Well, you have the choice. IMF is predicting what the Chinese are going to say economic growth is, what they're going to announce. And what they announce often bears no resemblance to reality. I think they'll probably announce growth a little above 9%, a little lower than the IMF says. What their real growth is, I don't think it's as low as zero, but I think it's probably more in the 6 to 7% range right now.
All right. Now, when you were at International Research, the global consulting firm, you wrote the China Weekly Bulletin, the China Quarterly. You also advised big U.S. and multinational corporations about their China strategy. What would you tell them today about doing business in China?
Well, you have a short-term and a long-term proposition. In the short term, one of your previous guests was talking about government-driven markets. Chinese markets are always government-driven. And they have a big political change coming up in 2012. You're going to get stability in the short term with China, stability this year, stability next year, stability into 2013. The longer term, after you get beyond 2013, you have a transition that the Chinese don't seem to want to make. What the IMF said to a consumption-driven economy, they don't seem to want to do that. They seem to be afraid of that. That could cause some serious problems.
So where is China going to export all of the goods that its factories make? If you have a slowdown in Europe and a sluggish recovery in the United States, who buys all that made-in-China product?
Right, that's exactly right. So the Chinese are still, they invest too much, they produce too much, they export the excess. Investment really drives their economy, but they need that export outlet. The export outlet continues to be weak. It's been weak for several years now. That's weakening the Chinese economy. They had that brief period of stimulus. It's gone away. You're going to get a slow weakening of the Chinese economy unless they're willing to move towards consumption as the engine.
What about IntraAsia trade, selling goods and services from China to other Asian countries? Would that make up the difference?
That helps because it's more economies to work with. But most inter-Asian trade right now is still driven by final demand outside of Asia. What Asia has created very successfully is a linked supply chain, a very efficient supply chain, but it's still selling ultimately mostly to the U.S. and to Europe. So it's helpful to have this inter-Asian trade, but it's not going to offset continued weakness in the major developed economies.
Derrick Scissors, what about Chinese government debt? There are reports that there are huge amounts of debt that are never really going to be repaid.
Those reports, we struggle with the amount, but those reports are generally accurate. Basically, the Chinese worked for a decade to fix their banking system. And when the crisis hit, they went back to, all right, we're just going to lend a lot of money. It's never going to get paid back. And all these debts are going to be dumped back onto banks. So one challenge that investors might look to in China is whether they can unwind the debt in their financial industry, or this is going to be a long-term burden that weighs down their growth.
Let's bring in Jack Hidary of Samba Energy and also Derrick Scissors of the Heritage Foundation. Gentlemen, let's continue talking about China. Jack, you are just back from a trip to China. Where were you and what did you see?
Went across the country, Beijing, Shanghai, Shenzhen, Hong Kong, other cities as well. What you see is the implementation, the beginnings of the implementation of the 12th five-year plan. China has had 11 five-year plans. This is now 60 years of business planning for a country. And the new plan is just adopted about 6-7 months ago. This plan calls for very, very aggressive targets in key areas of the economy, particularly in clean technology. So we're beginning to see the start of that with crushing the prices of solar worldwide and also the rise of electric vehicles.
Derrick Scissors, come in on this topic of subsidies for domestic industries in China. Are they doing enough to maintain any kind of balance, or are they just going to kill all external competition and then up with a China-only energy?
They'll try to kill all external competition. We've seen that in rare earths, for example. So, the Chinese solar industry grew up as a response to European preference for solar energy. The Chinese are heavily subsidizing it. Now demand around the world may be drying up, but the Chinese are still pouring money in. And the outcome is they'll accept the financial losses, and if they drive out the competition, so much the better.
Drive out the competition, Jack Hidary.
Well, here's the stats. China had about 5% of the world's solar market about 5 years ago. Today has about 60%. But the market is 5 times as large as it was because of the low prices of China. So yes, China's very aggressive. China's coming out with very cheap solar panels. That's probably what made Solyndra go bankrupt just a few weeks ago here in the US. But they've also helped to increase the size of the market by 5x because of low prices, now spurring demand.
All right, you brought up Solyndra, so I've got to push on you, Jack. What happened with Solyndra? This was almost like a test case in the United States for Department of Energy loan guarantees to boost the domestic production of solar energy products.
I think there can be some solar production here in the U.S., but Solyndra was actually kind of an odd case because they were using a non-standard technology that required you to change out the membrane of the roof. So if you wanted to install Solyndra, you actually had to change out the roof cover of your building. That required additional expense, and that was one of the things that doomed Solyndra. Solyndra was about $2.50 a watt production cost when China was selling at $1.20 a watt. So really out of the market right now.
Derrick Scissors, Jack says that the market for solar energy and clean technology energy, it's growing, and it's mainly because of China. But if they crush competition with government subsidies, isn't that unfair? Couldn't they be hauled before the World Trade Organization?
They could, and they probably will. What I would worry about first is that we saw the same pattern with rare earths. We've seen it in other industries. The market grows because the Chinese cut prices, absolutely right. Then when they drive everyone else out of the market, they have a monopoly position and they raise prices. So we're in the period right now where cheap Chinese products look like a really good thing. There are definitely advantages. What's going to happen, though, if they are successful at grabbing 90 or 95% of the market? Are we going to see price predation at that point?
I think one of the key points here, though, about solar, I agree with Derrick said, is that there's actually 2 parts of the solar market. There's the manufacturing of solar. That has a certain number of jobs. But 10 for 1, there's a ratio of installation jobs to manufacturing jobs. There's 10 installation jobs for every manufacturing job. So China today is the leader in manufacturing, but to install the stuff on the roofs here in America, you actually need the building trades, roofers, electricians, and others to actually come on the roof and make that installation happen. So we can actually create hundreds of thousands of jobs in this country if we continue to expand this space.
Derrick, I want to get your thoughts on whether China is going to come to the rescue of Europe. It's a little bit of a different topic, but they've got a lot of money. About 21% of all foreign-owned U.S. treasuries are held by China. Think they're going to spend some of that bailing out the Europeans?
No. I think this is mostly a lot of rumor mongering, which you get about when the Chinese are anywhere. They're going to buy this company. They're going to buy that country's bonds. The Chinese like safe haven, which is U.S. bonds, at least to this point. They like resources, and they like technology. Euro-denominated bonds are thin because there's no unified market, just national markets. They're not a safe haven. They don't embody resources. Right now, they don't embody any technology unless the Europeans are willing to sell. So you're going to get very small Chinese movement into European government bonds unless something fundamental shifts about what they might get out of it.
Derrick, when you look at the Chinese stock market, it has not performed well this year at all. Do you think there's a chance that there's money to be made investing in China, or is it just too difficult because of government interference?
If you have particular limits that you're going to set, like I'm going to buy here and I'm going to sell here, either for markets as a whole or for companies, you have a chance. But you've got to be aware that the tie between profitability and share price is really tenuous, if there is one at all. So when you're talking about, hey, Chinese economy is growing and the stock market's weak, they really almost have nothing to do with each other. You're going to have to guess at some other way of deciding whether the market's undervalued or not. It can be done, but it's a high-risk proposition.
All right, I want to thank you very much, Derrick Scissors, joining us from the Heritage Foundation.